Hello, I am Nitin Vishen and I teach finance at the Indian Institute of Management, Bangalore. In this video, I will talk about my research paper titled Does Social Capital Positively Influence Loan Performance Even During a Crisis? It was recently published in the Journal of Development Economics. This paper is co-authored with Professor Sumit Agarwal from National University of Singapore and Professor Prasanna Tantri from the Indian School of Business. In this paper, we study default rates of microfinance loans. Are you familiar with microfinance? It's a powerful financial tool that has positively impacted millions of poor people, particularly women in rural areas across the world. These people typically lack access to formal banking and without microfinance often resort to borrowing from local moneylenders at exorbitant interest rates and risk falling in a poverty trap. The core innovation of microfinance is the joint liability group structure pioneered by Muhammad Yunus through Bangladesh's Grameen Bank in the 1980s. This innovation earned him the Nobel Peace Prize in 2006. In joint liability group lending, women typically borrow as a group of 4 or 5 and share repayment responsibility. While each member receives her loan individually and repays it, the critical feature of the joint liability loan is that even if one member defaults, the entire group risks being labeled as defaulters. This structure leverages strong social ties, compelling members to repay loans promptly. Think of it like this. As a student, you study with a group of 2 friends. Imagine you are about to sit on an exam that is graded both individually and as a group. If any one of you fails, the whole group fails. Naturally, you would pitch in to help one another, boosting everyone's chances of passing. You might even pressurize your friends to study harder. But now imagine that one of your friends becomes seriously ill on the eve of the exam. Will the rest of you give up or work even harder to help your friend do better on the exam and keep the group afloat? That dilemma is exactly what we test in the financial world. We ask, when an economic illness strikes, say the COVID-19 crisis, and some group members struggle to repay, do joint liability loans collapse under the strain, or do peer ties kick in and improve repayment? To find out, we examined unique data set of roughly 25,000 rural Indian borrowers who simultaneously held 2 microloans from the same lender, one joint liability loan and one individual liability loan. By tracking their repayment records before and during the COVID-19 crisis, we could see which loans they chose to repay first and why. We found that these borrowers actually prioritized repayments on the joint liability loans over the individual loans during the crisis period. This behavior is even more pronounced amongst groups of women with stronger social ties, specifically those sharing similar castes or occupations. So our study shows that the peer effect embedded in the social capital lowers default of group loans by about 4 percentage points, which is roughly 35% of the average default rate before the crisis. It is this crisis resilience of the joint liability model that we unearthed, and it has helped scale this microfinance business to around 200 million low-income borrowers worldwide, making it one of the most effective lending technologies for the poor. If you want more details, I will be happy to share the paper with you. Thank you for listening.